You swipe a credit card. Nothing leaves your bank account. No money moves. But something appears. Debt. Not later. Not at the end of the month. Instantly. Most people use credit cards every day. Very few understand what actually happens when they do. What a credit card really is. A credit card is not a payment tool. It is not your money. And it is not a digital wallet. A credit card is a loan, a pre-approved loan that resets every time you swipe. When you use a credit card, the bank pays the merchant for you. You don't spend money. You create a short-term debt to the bank. This is why credit cards are called revolving credit. Unlike normal loans, credit cards don't have a fixed end. There is no final payment date, no clear finish line. Instead, the balance revolves. You spend. You pay a portion back. You spend again. The debt never fully disappears unless you actively stop using the card. This design is not accidental. It is the core feature of credit card systems. Why minimum payments never end. Every credit card statement shows a minimum payment. It looks small, harmless, easy to manage. But minimum payments are calculated to keep the debt alive. They cover interest. They barely touch the principal. As long as you pay the minimum, the system works exactly as designed. The debt continues, the interest continues, and the clock never resets. Credit card interest is calculated daily, not yearly, not monthly. Daily. This means interest is added to interest, a process known as compounding. The longer the balance exists, the faster it grows, even without new spending. This is why credit card debt can grow silently in the background. Fees, rewards, and psychology. Credit cards don't feel like debt. There is no cash leaving your hand, no immediate loss. Rewards make spending feel productive. Points, miles, cash back. The system is designed to reduce friction. The easier spending feels, the more often it happens. And the longer balances remain. Banks earn money from credit cards in 3 ways: interest, fees, and transaction charges paid by merchants. But interest is the largest source. Credit cards turn short-term borrowing into long-term profit. The longer the balance exists, the more valuable it becomes to the bank. In the previous video, we explained how banks create money through lending. Credit cards use the same mechanism. Each swipe creates new bank money and new debt at the same time. Fast money, short-term money, designed for constant circulation. Credit cards don't just change how people spend, they change how money moves through the system. In the next video, we'll explain why interest rates control everything.